All right, folks, today is Monday, October 3rd, 2022, and this is the portfolio review for September 2022. So all the numbers I'm going to talk about is as of the market close on Friday, September 30th. And boy, September was a doozy. I made my all-time low for the year on Friday. I'm sure many people have as well. It was just a bloodbath. The whole month of September was just crazy. But I'm actually, I feel fine about everything just because, I have a plan. I'm going to stick to it. It's going to sound like a broken record, but it's true. I have a plan and I will stick to it. The one thing that you'll notice, though, is that when I start talking about the portfolio performance, the difference between my performance and the broad market as measured by the S&P 500 is going to get a lot closer as I make more and more of these buys, not only in my $1 million public portfolio, but also my personal portfolio. I'm moving into this risk parity style allocation that has a lot of elements of Ray Dalio's all-season portfolio and other types of risk parity style allocations. So as I get more and more into this, the difference between my performance and the market will shrink. That's just bound to happen. But as of September 30th on Friday, my portfolio is down 17.2% year to date. This is compared to 24% for the S&P 500. So still doing quite a bit better. But like I said, I think this is going to close quite a bit, this gap, as I start making these buy-ins, especially now that I'm making double the buy-in that I normally would. The other thing that I did was I changed the axis on my performance chart because I had it bounded by negative 20% on the low end and positive 20% on the high end. And that wasn't going to work. So I just added 10% to each, the minimum, the maximum, the axis. And so you can see everything. And it looks better. In terms of portfolio allocation by sector, there was some big change I made in September for sure, and I'd like to take a little bit of time to talk about it. So overall, my cash position is still roughly about 36%, and this includes what I call short-term bonds. So when I say cash, it's real cash, which is what I'm using to rebalance the portfolios across the board, or it's money that can be converted into cash very quickly. And for a lot of that pile, I'm moving into an ETF that is SHY. I think it's a 1 to 3 year short-term treasury fund ETF from iShares. And the reason I did that was that, rates have been increasing for the last couple of months now, right? And what that means is that we're actually getting a reasonable return on bond holdings. And rather than keeping just pure cash, I'm moving a large portion of that into the short-term bonds, but still keeping a small portion in cash. I made some sales today. That's why I have 7%, just in anticipation of next week when I'll make my monthly buys. So that's probably my biggest change from last month. I continue to execute my plan where I buy into my risk parity style allocation in all of my portfolios. The one thing that I'm doing that's slightly different is that in a small portion of my portfolio, I'm using some of the leverage funds just to hopefully gain a little bit more return out of everything and give it a bit more juice. I set up kind of a separate portfolio that has about a quarter of my funds, and I'm going to play with this leverage allocation. It's basically the same as my risk parity style allocation. The only difference is instead of using like a large cap growth ETF, I'm using UPRO, which is a triple leverage S&P 500 ETF, and then I'm using TMF, which is a triple leverage long-term treasury. Everything else is the same, so I'm still using O for REIT, and then I'm using GLD for gold. That's really the only difference. But in terms of sector allocation, it hasn't really changed that much over the past month. So aside from what's going on with the portfolio performance and my allocation, how do I feel about what's going on? I don't feel good, but I'm not panicking. That's for certain. So, a lot of studies have shown that when you have a downturn, you feel like a lot worse than for a comparable, positive return. So, in other words, if you were down 20%, like we are year to date, roughly, you're going to feel a lot worse than if you were up 20%. Sure, you're going to be happy to be up 20%, but your level of happiness is not equivalent to your level of sadness, for lack of a better word, when you're down by 20%. So I don't feel great, but I don't feel that bad. And the reason I don't feel that bad is that I think this is the proper reaction from the market. In August, it was reacting very stupidly for some reason. It's almost as if the market did not think that the Fed was serious about fighting inflation. And I'm actually quite bullish now because I think that they are positive in fighting inflation. It doesn't mean that things won't get bad and that we won't have a recession. None of that. It just means that in the long term, our economy is in better shape or will be in better shape. And that's going to bode well if you're a long-term investor like I am. So I'm actually not worried at all. And I'm happy that I made this pivot to double up my buys so they can take advantage of the situation that we're in. So if we're in this decline, I might as well convert a lot of my cash to equity holdings and other holdings at a steep discount. And that's how I look at it. And if you're accumulating funds, you should look at it the same way. So while September was a bloodbath and I did make an all-time low for the year, I'm not worried about it. I will keep doing what I'm doing, and I hope you do too. So thanks very much for checking in with me, and good luck to us all. Later. Bye.